Raghav and I both approach things very differently, which is helpful because we always bounce everything back and forth. It's even, our personalities and our outlooks are very different. With the joke, but it's actually true, is I'm an endurance runner and he's a tennis player. And so he's kind of, where's the ball? What do we have to do? And I'm kind of going, we're going this way. And that's, so in order to understand what we're doing, I have to give a really quick background on what we've been doing, because what we're doing is we're bringing something that we've been doing to a new and better place. What we've been doing is solving a major problem in finance, which has to do with real assets. And we had we made the creative switch years ago saying, look, assets are always financed on credit, and that's extremely limiting, and it's the wrong way to look at them because then they're always treated like depreciating liabilities, when the reality is they're the thing that enables all the revenue. When we say real assets, we just mean hardware, hard assets that are the centers through which business is done so that revenue can be generated. And that's a very, very broad universe. And we actually created the first ever institutional fund. And we have institutional investors, including publicly traded funds. So we come from a very institutional space. And so we're used to being audited and understanding the complexities and the regulations and all that sort of thing. That's our life. But what we solved was, I'll go back. We created the first ever institutional fund that all it does is buy real assets and gets a share of the revenue that they generate. And that unleashes so much value in businesses because it removes the capex from the conversation. It's equivalent to the switch of software becoming SaaS, where it suddenly fits into an operating budget instead of a capital budget, and boom, it can do anything now because it can fit into any facet of the enterprise. Well, nobody had made that switch for hardware. It was largely limited by the financing structure. So we created a financing structure, and we actually have a couple of patents pending around some pieces of it because we couldn't believe that nobody had done this. And then looking at it more and more, we determined that these real asset pools that we have do a couple of things. They create very stable, high yield, non-correlated revenue, and they store value very effectively. And I was looking at the world going, I think value storage is going to be a big deal, because right now, if you want to store value somewhere, you're very limited. It's either in the traditional central banking system, or you buy a Picasso, or maybe some gold, and that's kind of it. We said, no, we've got these machines that these pools of real assets with revenues attached to them, and those revenues are non-correlated and they're not attached to market prices, and they kind of just mushroom over time. What if this could back an actual protocol, and what if we could create a marketplace where real asset owners could get the liquidity that they need, that we know that they need, and people who are trying to store value can participate in that value storage pool by way of the revenues over time. So that's very vaguely what we've built, and what we're building is we've fully architected a protocol that enables that to happen. And I'll be quiet there because I know Raghav has his take on it as well, but that's how I think about it.
Very
Hey,
cool.
before we do that, quick question. Can you give us some examples? Like, I'd love to have some like examples of these type of deals, because I think that'll be super, super easier to understand that way.
Sure. Yeah. How about I'll give a legacy example of what we've been doing, and then Raghav, if you want to give the example of how it would look on the protocol, since we were talking about that this morning, is that good with you?
Yeah, go for it.
So what we've been doing is we've been coming alongside a business owner. Let's give an example of a track and trace IoT company. So they've got a logistics platform where they're saying, "Hey, Mister Large Enterprise, we can tell you where all your stuff is all the time." Great. And they're solving an operating problem. They're optimizing operations. And so they're talking to an operations manager at a company that's bigger than they are, saying, hey, with our software, we've got this dashboard. We can tell you this and that, and we can save you 10%. Fantastic. Okay, we just need you to buy $750,000 worth of these sensors so that we can deploy them. And that's where it all comes to a screeching halt. And the ops manager goes, I don't really have a CapEx budget. I don't want to buy $750,000 of your nifty widgets. I want the software, though. Is there any way we can put those together? And the business owner to date is saying, I can't just eat that on my balance sheet, even though I know that I'll make a lot more money in the long run if I could. And there was really no mechanism to do that. So we were the fund that would come behind that tech company and say, don't ever sell your assets to anybody. We'll buy all of them, bake it into your recurring revenues, and we'll participate in that. And so we get the benefit. So all we are is a balance sheet as a service. We're the balance sheet where the hardware lives, and we get the revenue participation. And over time, we make a very nice return on owning those. And that enables that business owner to get out of the business of selling hardware, be in the business of solving a problem. It shifts box selling revenue into recurring revenue. Their valuation goes up, and their customer acquisition cost goes down, and their lifetime value increases. So it's a really powerful thing. So we'd say, okay, if your valuation goes from here to here, and our cost of capital fits inside that, you should do the deal. And that's what we've been doing, and we're approaching about 100 million under management, and we've done that, rinsed and repeated it a dozen times. So that's kind of the legacy wise what we've been doing, and we started it because we couldn't believe that nobody was doing that.
I love the inside baseball of this. I mean, it is, you guys are so ingrained, and it's such you have to know that this even exists. Otherwise everyone's kind of just walking right by anything like this. And it, again, makes perfect sense. And absolutely.
And that's a theme. There's a big theme in what we do of everybody assumes that problem's already been solved, but we keep finding the frustration that it turns out it hasn't really. Everybody assumes a bank will lend for hardware against revenue. They won't. They don't. They never have, and they never will. And so there's a lot of assumptions in finance, and I think in decentralized finance, assuming that somebody's already thought of that, or there's already a way to do that, when the world's changing very, very fast, and the reality is the innovation in finance really hasn't kept up in any way.
I mean, the interesting thing is, I think when we started, we didn't fully appreciate how big this problem was, and I think that's something that's worth mentioning. When we started, we thought, look, this is maybe a couple of $1 billion problem, and we can probably build towards that goal. The reality is, and this is just U.S. facts and data alone, there's $1 trillion worth of hardware bought and sold in the U.S. on an annual basis, right? So, and when you think of the definition of hardware is any hard asset. It could be an airplane. It could be an IoT sensor that goes in the back of a truck. It could be servers sitting in a data center wherever in Omaha, right? So there's literally very little that we don't consider hardware, quote unquote. And I think the most important thing is that once we start looking at the universe from the lens of, does that physical thing enable revenue, or is it critical to the revenue generation, then what we do starts to just open up more and more doors in terms of how we think about the application of where our solution fits. So I mean, look, and Joel's right. And we've had to learn that there's stuff that's sexy in the blockchain world and stuff that's not. A lot of what we do in the traditional world is not sexy, right? I mean, this is not stuff that people think about. People don't think about where their Dell Blade servers are sitting, and if they're and if they're doing anything of value apart from depreciating on a rack, right? So I think for us, part of the education has been how do we position things that kind of see that initial spurt and growth and adoption on the in the DeFi world and are interesting to people in the DeFi world. So so we could even just use Joel's example, or I can give another one in terms of how we see these real. So let me give the one sentence, like what we're trying to do with the protocol, and that'll give you a sense of the different applications for it. So we believe we're the first blockchain application that enables DeFi yield generation that's backed by real world assets and their revenue streams. I mean, that's basically it.
Okay.
Everything that you see out there today, the majority of the projects that are quote unquote real world asset backed are just centralized, or it's essentially a pure play crowdfunding type of scenario, right? And we've seen a lot of these with, I think even the Ritz-Carlton tried to launch a hotel and fractionalize a sale of the unit, essentially taking a fractional ownership model and putting on the blockchain. And they're interesting, but they're all very centralized ways of doing it. And and from what we've seen, there is no Web3 protocol that's actually backed by real asset revenue. And so our goal is to democratize this marketplace. And so essentially give asset owners that have revenue coming off their assets a way to monetize that today, as opposed to waiting for future revenue streams. And on the other side, give token holders or users that store of value that's backed by real world revenue streams, and do it in a way that's fully decentralized. So that's like the gist of what we're doing here. So simple example, again, this is not our sexy MVP or initial use case, but we'll talk it through with you guys so you guys can get a sense of how someone can use it, right? So imagine you're a small business owner that has a fleet of maintenance trucks that goes around town servicing vehicles. Business is good. you've got a fairly predictable revenue stream off of each vehicle. One vehicle equals X amount of dollars on a monthly basis. Great. So what you would do is, if you want to grow your business today, is if you approach a bank, then you've got the age-old problem, like Joel was describing, of how do I get more credit to go buy a new Mercedes Sprinter van or whatever it is in order to keep growing my business? Oh, well, I can't. I got to build my balance sheet, wait 6 months for the cash flows to come in, save it off. And then maybe in 6 months, if I go back to the bank, they'll see my balance sheet's healthy enough and they'll give me a loan to expand.
God forbid that vehicle is customized in any way for your business, because then nobody will finance it.
Yep. So this is just one simple use case, and we've done some work in the traditional space in this already, so we know this space well. What this business owner could do then is essentially come to the protocol, show the protocol exactly what they've done in terms of their historical performance, and pledge future revenues or share of future revenues to the protocol, and essentially make monthly deposits, monthly transfers into the protocol. And on the other side, we've got liquidity providers who will essentially buy a part of that future revenue stream and get yield for it. That's it, right? Now, how we do that and do it in a way that's essentially fractionalized NFTs that have utility value, that allow that to happen, is kind of the secret sauce that goes behind how we bring this together. But that's in a nutshell what we're trying to do. So the value prop is, as a small, in this example, as a small business owner, you're no longer constrained by traditional finance. You can actually access a market that historically you would never have been able to access, and get liquidity from future value to your cash flows today to grow your business at a rate that competitors who haven't thought of going this route can't. So I'll pause there.
I have so many questions.
Of course.
Let's start with the big one. How is this regulation? How are you guys regulating this, and what does this fall under? Because it sounds like you're creating a security.
Well, that's a really good point. And keep in mind, regulation is very much in our DNA in terms of understanding where we are. Because we're in a very regulated space, and we created an asset class that had no formal definition prior. And we had to create the entire legal ecosystem around that from scratch. Yeah. And we've spent
hence why I'm so excited to hear
SEC attorneys. And we talk to attorneys literally every single day, and have for years and years, because we've had to go through all of, like, even in our traditional fund, what is it? Is it a security? The answer is no. We actually don't have I used to have all the securities licenses, and none of it applies. So it turns out that when you focus on revenue, and there are more answers to this, but I just want to put this in the back of your mind. Revenue is its own beast, because when you have a revenue share or a royalty type stream, and you haven't lent anybody any money because all you did was collateralize something, then you fall into a really interesting gray space. For example, we've spent in our legacy business, we've had the pleasure of having 20 E&Y associates, Ernst & Young associates, on the other side, because they're trying to figure out how to audit, one of our major investors, and they can't figure out what we are, because we don't fit into any given box. And we think that's a strength. And now that's hard in the institutional world. It's very hard to raise money on going into a hedge fund and saying, here's something you've never seen before and don't know how to classify. Will you please give us tens of millions of dollars? And most of them say, we can't. We literally don't know how to allocate to that because it doesn't fit anywhere. But we sure do like your return profile. And every now and then we find one that we say can put on a cowboy hat and say, you know what, let's find a way to actually do this. And that's been our entire investor base to date, is those exceptional type ones. So you're absolutely right, Jay, that there is the regulatory world is not sure what to do with these kinds of things. All we can do on our side is do the very best we can to be as compliant as we can and follow the rules, knowing that they may change a rule at some point, and they may change a rule that affects our legacy business at some point. So far, so good. So far, we know our auditors ultimately understand. Sometimes they come to differing opinions, but they can all get to grips with everything we're doing works and makes sense. It's just hard to fit it into legacy systems.
Yeah. So so to get a little more specific, right? So the NFTs that represent the future value of revenue that we're getting from that the asset owner is getting from their asset being deployed really is a utility token that gives token holders the ability to vote on what types of assets are coming in, what type of liquidity is sent out, and really it's all handled through a DAO. It's a utility model, and B, decentralized, where there's no single person making a decision on we want this asset, we don't want this asset. We believe that this much, this asset's future revenue streams are worth X, and therefore we're going to pay out 30% of X to the asset owner at any given point in time. So the goals for us, we're facilitating that marketplace and doing it in a way that's through a DAO that we don't actually have any control over. There's some early initial verification layers in terms of, hey, are you actually, is your revenue stream really that good? Like, for an asset owner putting their assets on the platform. So there's some validation layers and verification layers.
Fortunately, that's what we've been doing for years, and we know how to kick it off the right direction.
Yeah, and a lot of that is like, it's rules based, it's algorithmic. It's not, and this is partly where some of the patent stuff that we have. I mean, it's a third party type of endeavor there. So we believe, and of course, look, the SEC is going after fractionalized NFT situations where I believe most of that's really more Ponzi like unsubstantiated models that don't really have anything backing their staking farming rewards that are coming out of there. So I think we're kind of staying away from that space completely in terms of how the NFTs, the fractionalized NFTs, will actually be used within our protocol.
So I'm curious, is the asset owned by the protocol and you effectively rent it to the owner, or do you finance it for them? Like, what's the actual legal structure of who owns the asset?
Yeah, the asset owner, I mean, so it can vary, right? In some situations, in most situations, the asset owner owns the asset or has legal rights over the asset, right? And so for us, really, it's a question of, are we enabling them to buy the next asset, the next truck, the next whatever, in order to keep growing their business? And obviously we'll have to have bad actor safeguards and all the other stuff, which we're going through the process of designing to make sure we're not, losing people's money that are coming through the protocol. But the whole thing is it's all algorithmic and rules based. So there's minimal intervention to do there. So the contract is literally a binding contract that me as an asset owner who has revenue coming from my assets will be submitting X amount of this revenue on a monthly basis, quarterly basis, daily basis, whatever it is, into the treasury of the protocol, and then the token holders will have essentially have rights to that treasury, and then be able to vote on how that treasury decides what to do with those funds. There's obviously some opportunities because we're building a true treasury, which is actually backed by USDC, USDT, whatever stablecoin assets we have as well, which are then able to be farmed, and that's a separate topic. But there's other things you can do once you have that treasury and that base built up within DeFi. But really, the function would be, what assets do we want to be a part of this treasury, and then theoretically, no one should ever want to redeem their tokens because the value of that token is always more in the future as the asset pool keeps growing. And if you do want to redeem it, then you get today's value for what that token is, not the future revenues that token is theoretically going to see. So that's how we think about that.
So real quick on that. The tokens are they in the wild? Are they able to be on any DEX, or is it only internal to a centralized kind of exchange that you guys are running?
No, it's a DEX launch. Yeah,
okay.
It's not going to be centralized. Yeah, it's a DEX launch, and we've there's the goal is to rebase, so duplex rebasing. So there's two layers of tokens, one at the asset pool level, and we're working through some of this logic right now where do we tie it at an asset level, or do we tie similar assets, vehicle asset pool, real estate asset pool, some other. There's different layers of aggregation and different layers of pooling we could do that allow counterparties on the other side to say, oh, look, vehicles look interesting. Oh, no, I only want the the Porsche rental sub asset pool, right? So there's some level of what will work in the marketplace and how do we position it. But the idea is like it's completely transparent. And then based on the actual revenue streams being pushed into the protocol, that rebases on a daily basis. So, hey, I was supposed to give you $100 today. I gave you 101. Great. That yield number ticks up. I was supposed to give you 100. I gave you 98. It ticks down. So an asset, a user on the other side can very, very clearly see what's happening with that asset pool or asset and make a decision on what they want to do with that holding that they have.
And I've always had the vision that it gets really, really interesting when you have that secondary token layer that's the aggregate of all the underlying assets, because that's where you have that really potent store of value saying, I'm holding a digital asset token that is backed by everything, where there's a whole lot of things that have to go wrong before there's nothing behind my currency. And I think that's going to be a really important part of the narrative going forward, is to have a scaling, to be able to really store value at scale in a transparent way that has real value behind it, and the value that's actually growing over time, not shrinking over time, and isn't relying on other people participating in order for you to keep getting your payout and yield. It's actually an organically stable value storage. And I think when you aggregate that and start thinking in the terms of, as we've seen, like there's a whole lot of assets out there that need this kind of solution. And if you get, even if you just had 10 different profiles of them, which is about what we run right now, then a lot of stuff has to go wrong before you're not seeing the storage and the value and the yield and the performance that you really wanted to see.
So what phase are you guys at right now of your roadmap?
We have designed and architected. We have all the legal entities in place and operating, and we set it up very carefully where the DAO is separate from the treasury, which is separate from the design. And so we've set it up as decentralized as we can, and in a way that can really scale that way. And that there was a lot of thought that went into that, even the jurisdictions of where we were and where we are with those. So the legal entities are set up. The front end functionality of the token functions. You can go to spaceprotocol.io and buy token, and that that does move into our treasury. We do, and we get that value immediately. So that functionality is there, and we also have fully architected what the backend protocol should look like to get to MVP. Now we're just starting to actually code it with our developers. That's kind of where we're at. I don't know what you call that stage, but that's where we are.
We're starting dev. We expect launch mid Q2, so 2.5 months, 3 months out from now is when we'll have the MVP on the up and running. We expect there'll be obviously iterations as we evolve how the treasury works and a couple of those things. We've there's a couple of, as a part of what we're doing. There's really like three, I guess. Partly, if you leave aside the Web3 decentralized approach that we've taken, there's two more fairly interesting things that we've had to develop in our architecture. One is a new EIP, Ethereum Improvement Protocol, because there is, believe it or not, there is, and we didn't realize this was the case, but there is no EIP out there that allows us to do what we're doing, and so we've essentially had to design our own in order to make this work. And really, it'll use part of the EIP 1155 standard, and then additional logic for the asset token logic, mapping assets to the asset level tokens, and then some duplex rebasing that we need to do. So that's going to fit in within our new EIP standard, EIP 1543. So that's I guess one fairly significant innovation that's come as a result of our design and architecture. And the second is, look, we intend on using IPFS as a storage layer on our side. So obviously, taking the benefit of the Filecoin protocol as much as we can to enable this. So there's a little bit of there's a lot of thought and nuance that's gone into how we've architected it. Dev starting, I think. Our learning curve is now on what's the first sexy asset to bring on the protocol, right? I think, are people going to be excited about IoT hardware that's sitting in the back of a truck somewhere? I don't know. We'll need to have more discussions around that. But the good news is, right, we have existing relationships and we have these existing businesses that we already work with, where this is just a natural fit. So we have access to 40, 50, $60 million worth of assets that we can bring onto the protocol on day one. So it's not like we're sitting around waiting. We can be our own guinea pig, and then not only and then very rapidly as we see different verticals that we want to go after. Maybe it's real estate, maybe it's something else. We have those networks established already. Just bring people on, and build the total value locked in the protocol from day one in a pretty fast way, and then increase adoption from there.